Hello guys, this is Shoaib Yaqub. In this video, we are going to discuss few MTQs of September-December 2021 exam. Starting with the number one question, in relation to the return on capital employed investment appraisal method, which of the following statement is correct? ROCE leads to better investment decisions since it uses accounting profit. No, the method which use the cash flow techniques are better method. Investment projects with a ROS greater than the WACC. ROS has no relation with the WACC. So this is also wrong. Investment project with a ROS less than the current ROS of an organization should be rejected. There is no such rule. If the company decides, if the company make the benchmark that current ROS should be the benchmark, then it should be the decision. Otherwise not. Otherwise, you should not compare ROS with the current ROS. You should compare the project ROS with the benchmark. ROS takes into account all years of operation of an investment project. Yes, this is the correct one. This is the answer. D is the answer. A large listed company is to issue 90-day commercial paper with a nominal value of 10 million. Each paper will have a nominal value of 100,000. The annual required rate of return is 4%, assuming a 365 days credit, 365 days in a year. What will be the issue price? Remember, the formula of issue price is you will take the nominal value in the numerator, divide by 1 plus 4%, 0.04 into 90 over 365. That will be equal to 99,023. Maybe some of the students will take 4% of this value and then into 90 over 365, then deduct from the 100,000. That will be equal to 99,014. But that's not the correct way. This is the correct way to calculate the value. Next is match the characteristics below with the appropriate working capital strategy. Relative high level of current assets, relative low level of current assets, relative large amount of short-term finance, relatively small amount of short-term finance. So if you are investing and having a high level of current asset, that is conservative investment working capital policy. When you have a high level of current assets, that is conservative investment strategy. So this is the right one. When you have a low level of current asset, that is aggressive investment strategy. And what about the financing strategy? Financing policy is how you finance the current assets and non-current assets. So if you are financing relatively large amount of short-term finance, if you are financing your current assets with large amount of short-term finance, that is aggressive policy. And if you are financing your current asset with large amount of long-term finance or with short amount of current finance or short amount of short-term finance, that is the conservative policy. So working capital investment strategy is how much you are investing in current assets. If you're investing too much in the current asset, that is conservative investment policy. If you're investing very low amount in the current asset, that is aggressive investment policy. This is separate policy, working capital financing policy. Financing policy. How you are financing the current assets. If you are financing the current assets majority with the short-term debt, that is aggressive policy. If you are financing the current assets with long-term debt or short-term with very short-term debt, that is conservative policy. A company has announced that it will pay an annual dividend equal to 55% of the earning. Its earning per share is 0.8, 10 billion shares. Return on equity is 20%. The current dividend share price is 4.6. So first of all, calculate the dividend. That is 0.8 into 55%. That is equal to 0.44. X market value will be equal to 4.16. And the growth will be equal to, if company is paying 55% of the dividend, retention ratio is 45%. Return on equity is 20%. So the growth will be equal to the 9%. So KE will be equal to 0.44 into 1.09 divided by market value 4.16 plus 0.09, and that will be equal to 20.5%. B is the answer. Next is the OT case. Following information related to D company, a company that is listed on a large stock market. Okay, income statement is given, balance sheet is given, preference share capital consists of irredeemable 6% preference share with a nominal value of 0.5. Cost of capital of preference share is 8%. Ordinary shares have a nominal value of $1. Company is a P ratio of 12 times. Future share price growth on the stock market is expected to be 6%. Long-term borrowing consists of 7.5% convertible loan. Nominal value $100. These loan notes can be converted at the end of 6 years into 40 shares or redeem on the same date at a nominal value of $100. Before tax KD is 6%. So what is the market value of the preference share? Preference share is 6%. Preference share par value is 0.5. So if you take the 6% of 0.5, that is equal to 0.03. Divide by 0.08. So market value will be equal to 0.375. This is per share, and number of shares are into 10 divided by 0.5. 7.5. 7.5 is the answer. A is the answer. And using the P ratio method with the value of D company. So the price to earning ratio is 12 times. And the EPS is 4 million. But if you look at the income statement carefully, the profit of the dividend of the preference share has not been deducted. So that's the problem with this. So what we have to do, we have to pay dividend on this 10 million as well. And that is 6%. So you will multiply 12 into 4 million minus the 6% of 10 million. So that will be equal to 10 into 0.06, 4 million minus 0.6 into 12. So the answer will be 40.8. Remember, you should take that earning which is available to the ordinary shareholders. So although the formula is earnings into PE ratio, that is equal to the market value, but which earning? Which is available to ordinary shareholders. Next is based on the current ordinary share price of $2 per share, what is the market value of the convertible debt? Convertible debt, that is, so how many years are there? 6 years. Cash flows, what is the par value? 7.5. And let's calculate the redemption value is 100. Conversion value is 40 shares into 2. You will receive 40 shares into 2 and share price will grow by 6%. So it will be equal to 113.48. And you will discount with the before tax cost of debt, that is 6%. So it will be 1.06 raised to power minus 6, 0.704. And when you calculate the annuity, it will be 4.917 into 7.5, that is equal to 36.88. And the last one is 113.48 into, that is 79.99, almost 80. When you club the answer, that is 116.88. 116.88. That is for one bond. And here the number of book value of the bond is, convertible bond 18 million into 18 divided by 100 into 18 divided by 100. That is 21.03. So nearest is C answer. 21.03. So C is the answer. Next is, in relation to the information requirement for valuing shares, which of the following statement is correct? A option is only information on the market value of tangible assets should be used in valuing shares. No, because many companies have many intangible assets. Shares are likely to be mispriced where managers and investors have different level of information asymmetry. Yes, that is true. Share prices are normally mispriced because the investors and managers have different level of information. Obviously, managers have superior level of information. Details of key personnel are not relevant to the market capitalization of a listed company. Yes, it is relevant because if the key personnel leave the company, it may affect the company future. Since companies do not release information that undermines their comparative advantage, most of the public information about a company is not relevant to placing a value on its share. No, that's not the case. Although companies may hide the key information, but still public information are useful in valuing the company. Question number 5. In relation to a behavioral finance, which of the following statement are correct? When investors believe that recent share price increases will continue, this can lead to irrational investment decision by uninformed investors. Yes, that is true. That is momentum effect. That is called the momentum effect. Because when you buy the share prices in that environment where share prices are continuously increasing, that is called the momentum effect. That is true. Informed investors can contribute to speculative stock market bubbles. Yes, informed investors can contribute to speculative stock bubbles. Why? Because if prices are continuously increasing, informed investors will buy the stock in hope that they will sell future at a very high price. So that is also true. C is the answer.